All right, let's dive into a really tricky area of tax law, one where personal injury cases slam right into federal tax policy. It's a spot where, honestly, one small oversight can spring a huge tax trap on your client, turning what should be a moment of relief into a serious financial headache.
We all work with this basic assumption, right? That personal injury settlements are tax-free. It's practically a mantra in the field. But here's the thing. What if that's not always true? The Internal Revenue Code actually has this built-in mechanism that can, believe it or not, claw back part of that settlement and make it fully taxable income.
And that mechanism has a name. We call it the medical deduction clawback. It's all driven by Internal Revenue Code Section 111, which you might know as the tax benefit rule. And it's this exact rule that can take a supposedly tax-free recovery and turn it into a major and usually a completely unexpected taxable event for your client.
So to really get our arms around this, we're going to walk through it step by step. First, we'll bust the whole tax-free settlement myth to get our foundation right. Then we'll look at the three key statutes that work together to create this rule. After that, we'll see how the clawback actually functions, and I'll show you the dangerous allocation trap that gets so many people. We'll wrap up with the playbook on audit risks and how to defend your client's position.
Okay, let's start at the beginning. To really understand the exception, the trap, you have to have a rock-solid grasp of the rule that everybody thinks they know. So the baseline principle is right there in IRC Section 104A2. It says pretty clearly that damages you get for personal physical injuries don't count as gross income. The theory here is what's called a return of human capital. The idea is that the money isn't profit, it's just making the person whole again, restoring them back to where they were before the injury.
But, and this is a huge but, buried right in that statute is the exception that creates this whole clawback mess. That tax-free exclusion does not apply to any money that repays medical expenses the client already deducted on a past tax return. And why is that? Well, it's because the tax code is all about preventing a double benefit. You just can't get a tax deduction for paying a bill and then also get a tax-free reimbursement for that very same bill. The government's logic is, hey, we helped you out with a deduction. Now that you got paid back, you need to pay back that benefit.
Now, to really get what's happening here, you have to understand the legal machinery it's built on. It's not just one rule. It's actually the precise interplay of three different sections of the Internal Revenue Code.
Pillar number 1 is Section 104A2, the one we just talked about. This is our starting point. It's the broad shield that makes these damages tax-free in the first place. But as we're seeing, it's a shield with a very specific hole in it.
The second pillar is Section 213, the medical expense deduction. This lets people deduct their out-of-pocket medical costs, but only the amount that's over 7.5% of their adjusted gross income, their AGI. Now, for most folks, that AGI floor is so high they never get to use this. But in a catastrophic injury case, the medical bills can be astronomical, blowing past that threshold easily. And that is what sets the stage for the clawback, getting that big deduction.
And that brings us to the third, and I'd say most important pillar, Section 111, the tax benefit rule. This is really the engine of the clawback. It's all about fairness over time. It basically says, look, if you get a tax break for an expense in 1 year, and then you get that money back in a later year, you have to report that recovery as income. But, and this is key, only to the extent that the original deduction actually saved you money on your taxes.
Okay, so that's the theory. Those are the statutes. Now let's get practical. How does this actually happen in the real world, from the moment of injury to the moment that settlement check gets deposited?
The sequence here is absolutely critical. First, your client gets injured and pays medical bills out of their own pocket. Second, that tax year, they file the return, they itemize, and they claim a deduction under Section 213, which lowers their tax bill. That's the tax benefit. Third, maybe a year or two down the road, the lawsuit finally settles, and that's when Step 4 hits. The part of the settlement that pays back those previously deducted expenses is now officially a recovery under Section 111, and boom, it's taxable income in the year they get the money.
Let's put some numbers on this so it's crystal clear. Let's say your client has an AGI of $100,000 and they paid $10,000 in medical bills. Well, that 7.5% AGI floor means the first $7,500 of those bills aren't deductible at all. They get no tax benefit for that part. It's only the amount above the floor, that remaining $2,500 that they actually got to deduct. So when they later get a $10,000 settlement for medicals, it's only that $2,500 portion that actually gave them a tax break that gets clawed back as income. The other $7,500, that stays tax-free.
And this example really shines a light on some super important limitations.
First off, if your client just took the standard deduction, you can forget about the clawback. There's nothing to recapture because they never got a specific tax break for the medicals. Second, like we just saw, that AGI Floor acts as a shield for the first chunk of expenses. And third, there's a partial benefit rule. So if itemizing only saved your client, say, a couple $100 over the standard deduction, then only that small amount of the recovery would be taxable.
Okay, now we're getting to what is, frankly, the most critical and most dangerous part of this whole thing. It all boils down to the specific words you use or don't use in the settlement agreement. And the IRS has a default rule here that is just an absolute disaster for your client.
This all comes from Revenue's Ruling 75-230. And it says that if your settlement agreement is silent about how the money's allocated, well, the IRS is just going to presume the money is from medical expenses first. So let me be really clear. In this context, silence is not neutral. Silence actively works against your client because it forces this first dollar attribution right to the part of the settlement that could be taxable.
This just lays it all out, doesn't it? When you have an explicit, reasonable allocation in the agreement, you control the tax outcome. But with a silent lump sum agreement, you are literally handing control over to the IRS. They'll just apply Revenue Ruling 75-230 and guarantee the maximum possible clawback. This right here is the single most important strategic decision you can make.
Let me show you just how punishing this first dollar rule can be. Say your client sues for $1 million, and part of that claim is $50,000 in past medical bills. The case ends up settling for $100,000, just a lump sum, no allocation language. Well, under the IRS's rule, the very first $50,000 of that settlement is automatically treated as a reimbursement for medical expenses, which then triggers the clawback. You can't argue it was for pain and suffering. The rule says medicals get paid first and in full.
So we know the traps exist. The question is, how do we defend against them? This brings us to our professional playbook, understanding the audit risks and building a rock-solid defense.
You know, the IRS audit technique guides actually give us a peek behind the curtain. Auditors are literally trained to ask for the original lawsuit complaint to see if medical damages were specifically claimed. A silent settlement agreement is an immediate red flag for them. It's their green light to apply their harsh presumption. They also look for things like large, unexplained bank deposits, and they notice patterns, like someone having high medical deductions for a couple of years that suddenly drop to zero. That screams settlement.
This makes our defensive playbook pretty straightforward. First and most importantly, draft explicit allocations in your settlement agreements. Call out specific amounts for tax-free things like pain and suffering. Second, always do the math. Calculate the client's actual tax benefit from their prior deduction. They never, ever have to include more income than that amount. And third, you can even play chess here. If you know a settlement is very likely next year, you might advise the client to just take the standard deduction this year to completely sidestep the entire problem.
And just when you thought it couldn't get worse, there's one last nasty trap to watch out for. After the Tax Cuts and Jobs Act, the situation got even more brutal. For that taxable part of the settlement, the clawback amount, your client generally gets no deduction for the attorney's fees they paid to get that money. Think about that. They have to recognize gross income and pay tax on it without being able to deduct the cost of earning it. It's an absolute gut punch.
So if you remember one thing from all of this, let it be this. When it comes to settlement agreements and taxes, silence is not golden. In fact, it's probably the worst possible strategy. A silent lump sum agreement isn't a neutral document. It's basically an open invitation for the IRS to come in, apply its harshest rule, and maximize your client's tax bill. Proactive, explicit drafting is your only real defense.
And that really leaves us with one final question, a question every single one of us should ask after every negotiation. When you look at that final settlement document, is it drafted to protect your client, or is its silence actually drafted to benefit the IRS?